you, everyone, and welcome to this week's Insigneo speaker series. It's a little bit different today. We're not going to do the usual risk with Riesgo. We're doing a very special interview today with Louis Gave. Louis, very nice to meet you in person finally.
I'm so happy to be here. Thanks so much for having me.
Thank
you.
Real
honor.
So Louis, for those of you who don't know, is the founder or co-founder of Gavekal Research. His father as well, Charles Gave, and Anatoly Koletsky, right?
Yep.
So I got that right. So anyway, so we've been subscribed to Gavekal's research for a couple of years now. So it's great to have him here. It's going to be fun to have some conversations with him here over the next 45 minutes. So Louis, let's get started with sort of the small stuff, and then we'll work our way to the bigger stuff. How does that sound?
That sounds terrific.
All right, so let's start with a question that's on a lot of people's minds. Did the Fed actually achieve a soft landing?
I think we haven't had much of a landing at all, to be honest. You look at most of the economic data, starting perhaps with tax receipts that continue to grow double digit. You look at employment, record number of people working, which of course goes along with tax receipts. I think the economy continues to hum along. You've seen this week's cover of The Economist of a rocket ship taking off. Mm-hmm. No, the U.S. economy is humming along. So I don't know if it's been a soft landing or no landing at all, but yeah, if the Fed was trying to maximize for employment, I think they've done it.
Well, whether it's a soft landing or not, you're right, it's still up to for debate, but if it's a no landing and we reaccelerate, that presents its own problems, right? So what sort of, let's say, warning signs are you looking for the more pernicious outcome where the economy perhaps even reaccelerates and the Fed might be forced to slam on the brakes?
So look, I think the real challenges, of course, is when inflation reaccelerates. Mm-hmm. So on that front, you could say, well, the Fed's been decently successful, right? We had 9% inflation, brought it back down to 2.5%. Everything is good. And as long as inflation doesn't reaccelerate, you're pretty much in a happy place.
And how comfortable are you that inflation is not going to reaccelerate?
Well, to be honest, as long as energy prices stay controlled, you got food prices coming back down. The one perhaps pernicious thing within the whole inflation framework is labor costs continue to creep higher. Mm-hmm. But that means that people at the bottom rung of societies, the waiters, the mechanics, et cetera, are earning more, which isn't such a bad thing.
Right.
For 20 years, this was the part of the market that kept getting squeezed. So, if workers earn more, is it such a bad thing? Perhaps not. So today, I think when you break down the inflation data, what's quite fascinating, quite interesting, is everything that's linked to wages. Let's say your haircut, nursing, taxi drivers, etc. You're seeing 4% more or less wage increases on all these things. And I think that's where we are, to be honest. I think we're in a 3 to 4% inflation rate. It's driven mostly by labor, but I'm not sure it's such a bad thing. If you're the Fed, do you need to fight this while energy prices are still in check? Perhaps not. We just in an environment where growth is pretty high, inflation is pretty high, therefore tax receipts are high, growth is okay, party on.
So a bit of an inflationary boom, right? I know that's a framework you guys have used in the past. Now, some people would argue that the Fed actually wants inflation at 3%, right? It's a stealth way to sort of undo the U.S.'s debt profile, which is getting quite, let's say, worrisome here, right? What are you looking at in terms of the U.S.'s fiscal position, right? Because it seems like both candidates, whoever wins, and we'll talk about that now in just a second, whoever wins, it looks like no one is even interested in thinking about the U.S. fiscal deficit, right? So
no, look, that's right. And look, when you're over 100% debt to GDP, really there's two ways you get out of your problem. Typically, either you restructure your debt, which creates massive problems throughout the entire financial industry, or you inflate it away. And let's not kid ourselves, that's where we are today. You've got a nominal GDP in the US that's growing by 7-8% between the inflation and the GDP growth, which means your tax receipts are growing by 10%. And on the other side, you're paying 4% for your debt or 5%. So that's how you chip away at the debt. And this is what occurred through the 1950s, through the 1960s. And that's what's occurring today. So it means that, to be honest, over the very long term, bondholders are the turkey. They're the ones who end up being sacrificed. It's the one asset class that's, is sort of priced in for constant real losses. So you want to be anywhere but there.
Yeah. So it seems that we really share this view that long-term structurally, we're in a bear market in bonds, in U.S. Treasuries, right? Rates are heading higher, not in a straight line, of course, but in a stepward fashion up, right? Higher highs and higher lows each time.
And I think you've just seen that. The Fed cut, what was it, a few weeks ago, 3 weeks ago, sorry, 4 weeks ago. The Fed cuts and bond yields rose.
Correct. Yeah.
If that's not the signal, then I don't know what is, right? That's your signal right there. So now the Fed is in a situation where, hold on, if they cut again, probably bond yields go up further and yield curves steepen further. So yeah, what's the point of being in bonds in that environment? Typically you buy bonds thinking, the Fed is going to cut. Therefore, I want to be at the long end of the curve.
Right.
But if now, the Fed is going to cut, the long end is going to sell off. What's the point?
Right. So we have been structural bears on treasuries, but we had tactically put in a long duration trade because we have higher risk of recession. But that seems to be receding. We're actually thinking about undoing that short-term tactical trade that we had to go long duration. What's your view with 10-year rates at 4.12? Would you be taking on risk? Would you be neutral? Would you? So where would you be?
I think we're heading to 5, and I think we'll be heading to 5 pretty soon after the U.S. election. For the very reason you just highlighted, it's pretty much regardless of who wins. And I'm not trying to be partisan, but regardless of who wins, you're getting bigger budget deficits. They've both the candidates have tried to outdo each other in promises of tax cuts, in promises of more spending, and unless there is one scenario where, if Kamala Harris wins and you get a Republican House, usually, when the Dems control the White House and the GOP controls the House, then all of a sudden the Republicans remember that they're supposed to be the party of fiscal rectitude.
Right.
And at that point, they massively cut spending and prevent the executive from having access to money. So in that scenario, you could see, okay, US dollar strengthens, bond yields go down. That's a scenario to be long bonds. But that right now is not the scenario given to you by the polls.
Correct.
Now, I'm not saying it can't happen.
Sure.
But assuming that scenario doesn't happen, that you either end up with a red sweep or a blue sweep, I don't see why you'd want to be long U.S. Treasuries.
Right. So we just checked the betting markets this morning. I don't know how closely you follow them or not, but Trump has surged in the last couple of weeks. He's sitting at around 60% on an aggregate level. Kamala's around 40. If you look at the different scenarios, like on Polymarket this morning, I checked, the Republican sweep scenario was around 42, 43%. And then you had, mixed government and the Democratic sweep scenario all the way down to 15%. What's your take right now? What are you, let's say, positioning yourself for? And at the same time, what are you hedging against?
Yeah. So look, I think you have to go with the polls. You have to assume we're going to have a red sweep. And then from there, the big uncertainty is how does Trump govern? Now you could say, well, we sort of know because, he's been here a first time around.
He's been here before, right?
He's been here before. Having said that, the people who are around Trump today are not the same people that were around him in 2016. If you go back to 2016, and I think where this matters a lot, to be honest, is in terms of foreign relations. If you go back to 2016, the people around Trump were people like Mike Pompeo, John Bolton, Nikki Haley, neoconservatives who really split the world between good democracies and bad non-democracies, and who were especially adamant of trying to box out China and treat China not only as an economic competitor, which it is, no doubt, but really as an enemy.
Right.
Now, when you look at the guys who are around Trump today, guys like Bobby Kennedy Jr., Tulsi Gabbard, Elon Musk, Scott Bessent, these are people who are far less anti-China. Now, I bring it back to that because, we're based in Hong Kong. We spend a lot of time looking at China. So for us, one big uncertainty right now, I think, as you've seen the market start to price in a much stronger odds of Trump, what have you seen? You've seen China sell off in spite of all the stimulus that's been put in, et cetera.
Right.
The past 3 weeks, China sold off. Energy has sold off. Commodities have rolled over. I think partly because the world is starting to price a world where, Trump comes in and puts up huge trade barriers and basically, freezes out foreigners. But I don't know. I don't think it's going to play out that way. Mostly because, again, the people around Trump this time around are very different from the people of 2016.
Yeah. And if you actually listen to what Trump has been saying in his speeches and in his campaign stops, I don't know if you've actually taken the time. I mean, because there's one thing is like what the mainstream media reports, which fits or does not fit the narrative. But if you listen to what he's been saying, he's actually been saying that he kind of sounds like he wants to make a deal,
I
right?
think so.
Right? He sort of wants China to build factories in the United States.
And I think
right?
I think that's a huge shift.
Yeah.
To be honest, it's a huge shift, even from the Biden administration rhetoric, which very much treated China also as an enemy. No, you're absolutely right. Trump is going around saying, hey, look, I want BYD to build a factory in Michigan. I want Li Autos to build a factory in Tennessee. And he is opening the door to some kind of grand bargain with China, a grand bargain that would somewhat, if you go back to the 1980s, in the 1980s, the US dollar was massively overvalued. The yen and the Deutschmark, which
just like it is today, right?
The yen and the Deutschmark were massively undervalued. And you had the Plaza Accord in 1985. Everybody got together and agreed, okay, we'll push down the dollar, we'll bring up the yen and the Deutschmark. And as they did that, you removed a huge uncertainty in the system, because for the previous 5 years, as the dollar kept going up and up and up, everybody kept getting squeezed. Anybody who had US dollar debt, whether Brazil, Mexico, et cetera, who had US dollar debt, got absolutely squeezed and crushed. And Mexico went bust, and Brazil went bust, et cetera. You removed that sort of Damocles sword of a potential squeeze, and all of a sudden these places boomed. And the places that boomed the most were the countries that had pegged currencies to the United States, because as the dollar was pushed down, if you were Taiwan, if you were Korea, if you were Hong Kong, you had no choice but to push down your currency as well, which meant printing a lot of money. And that money ended up in your economy and bidding up asset prices, bidding up activity. Like the bubble, you can read up on it if you're watching us on TV, but the bubble in the mid 80s in Taiwan was probably the most epic equity bubble the world has ever seen. Literally everyone quit their jobs to day trade equities. Nobody was working in Taiwan. It was really quite fun.
Right. And you would know this because you were nearby, right?
Yeah, exactly.
You were in Hong Kong.
And people still talk very fondly about that period. And, Hong Kong, from 85 to 87, the stock market went up 2.5 times, thanks to what was then called the Plaza Accord. Now, what's fascinating, to your point, is, Scott Bessent, who's rumored to be Trump's Treasury Secretary, was asked on Bloomberg TV a couple months ago. He was asked, he was told, if you're going to do a 60% tariff, it's going to be a huge inflationary shock for the US. He said, no, you don't understand. What we do is we do 2.5% month one, and then 2.5% month two, until China comes to the negotiating table and is willing to talk down the tariffs. Now, just with that, there's a huge information. Talk down and bring its currency up, and do basically and revalue its currency, because China's currency today is so stupidly undervalued. China's running trade surpluses of 80 billion a month. So just in that, there was massive information, because it already shows that the Trump administration is not looking at tariffs as an end in itself to break away China and the US, but as a means to an end, as a tool of negotiation. And then the Bloomberg interviewer asked Scott Bessent, he said, well, it sounds like you want a new Plaza Accord. And he said, and I fell off my chair, he said, you mean a new Mar-a-Lago Accord? And I thought, oh my God, they have a name for it.
They have a name for it. They're ready for it.
They already have a name for it. They already won this. So I highlight this because I think right now the perception of the market is Trump comes in, he's going to come in with a wrecking ball. It's going to be terrible for global trade, et cetera. But what if he comes in, and it's a what if, I don't know if that's going to happen. It's what if. What if he comes in and strikes a deal to bring down the US dollar, to bring up emerging market currencies? Then emerging market are obviously going to boom. Emerging market debt is going to go through the roof. US dollar is going to go down. There's a lot of assets that will reprice very, very rapidly. And because most people aren't positioned for that at all.
Well, look, like I said, I tend to agree with you in the sense that I think Trump actually wants to make a deal. But let's think about this, how it will work out, because in order to make this deal, things have to get bad, right? So the threat has to be credible, and there has to be pain up front in order to China. Because remember, this is going to basically entail China taking factories out of Mexico and moving them to Michigan, taking factories out of Shanghai potentially and moving them to Arkansas. So there's going to be pain. So this is not something the Chinese are going to want to just do. They're going to have to do it only if they think this is the way to make a deal with Trump, right? So how bad do things have to get first before a deal can be made? Or do you think maybe it's not so high? Maybe the Chinese are ready to play ball and they've been signaling to each other that they want to make a deal.
No, I'm not sure that China wants to make a deal today, but I'm going to make like a Jesuit priest and answer your question with another question.
Oh boy, I went to a Jesuit high school, so I'm hopefully I've not heard this one before.
So did I. You know, growing up, I was one of my friends actually pushed me to go see one of our teachers, and I said, Father, you know, is it true that Jesuit priests always answer a question with another question? And the father looked at me and he said, who told you that? But
that sounds like one I heard before.
Anyways, so I'll answer your question with another question. It's, what does China really want? Like, does it really want to sell cars in the US? Actually, China doesn't care. In fairness, you know, China's already the biggest car exporter in the world. Mm-hmm. And what it's really looking to do is opening up new markets. It wants to sell cars in Indonesia and in Chile and in Brazil.
But China wants global trade, right? Because China, of course, China has a savings problem. Well, they save too much, right?
China wants global trade because they're the most efficient producer in the world today. Right. You know, it used to be that China's selling proposition was to produce goods that were 70% as good as the rest of the world for 70% of the price. It's no longer the case. You look at Chinese cars today, they're better than our cars. I promise you, I know it's mind-blowing to think that. Most people don't realize it because nobody's visited China in the past 5 years. But they produce, you know, BYD, I'll give you an example. BYD just came out with a new version of the BYD Chin, which is like the Toyota Corolla. It's like so the car costs 100,000. It's like a sedan, nice sedan. It's the plug-in hybrid version goes 1,300 miles on one tank of gas. You can drive from Miami to New York on one tank of gas. It's a revolutionary car. Most people drive 10,000 miles a year. Right. That means you fill up your car 6 times in a year. Right. Like, at which point you're like, do I need an electric car?
Right.
And by the way, that car, the price, $14,000 US.
Yeah.
So it's, you know, they're changing, like they've leapfrogged us.
But look, they've pumped a lot of money into this, right? Because they're like, no one is consuming in China, so we need to find other markets. How
people are consuming in China? Like,
are they? Okay, yeah. So we can talk about that in a second.
Car sales in China are at all-time highs. Movie ticket sales are at all-time highs. We have a big real estate contraction, but you know we still have 5% GDP growth. But I want to come back to what does China look for from the U.S. Because indeed you could say, well, before China comes to make a deal, the U.S. has to impose a lot of economic pain on China before China comes to the table. I think that's the general perception today. Now, here's the reality. The ability of the US to unleash massive amount of economic pain on China is a lot less than it was 10 years ago. Because today, you know, China's exports to the US are only 15% of China's total exports.
Right, much less than they used to be. Yeah.
China now exports more to Southeast Asia than it does to the US. However, and this is where I think perhaps you know, the US perception isn't quite right. There's a lot of things the US can do for China that will bring Xi Jinping to the table. The things that the US can do, you can ease up the semiconductor sanctions, you know, that Trump put in the first place. So it's like, come to the negotiating table, and I loosen up on the semiconductors that you need for your growth. So that's one. Second one, and most obvious one, is I stopped selling the high-end precision missiles to Taiwan. Few people realize this, but China economically used to be built around its 2 rivers, the Yangtze River and the Yellow River. So it went deep inside the country. In the past 25 years, China's economic center of gravity has moved completely along the coast. Everything has gone along the coast. So everything, which means everything is within reach of Taiwanese missiles.
Right.
So if you're China today, it's a little bit like, imagine that, well, actually Florida has been booming. And imagine if China was selling high precision missiles to Cuba. You know, how would Americans feel about that?
Yeah.
You wouldn't be that stoked.
Well, that's always an analogy we've used here, which is like what's happening with Taiwan and China is the reverse of the Cuban Missile Crisis, where we're now the Soviet Union trying to break a blockade, and China's the one saying, "Hey, we might just blockade this," right? So let's finish off on the U.S. first, because I do want to talk about China quite a bit, because I know you're based there, and Gavekal is known for the research there. On the U.S. side, we've talked about the elections, we've talked about the economy. How about U.S. markets, right? Because there's this perception, right? We've had actually several years where the economy wasn't so great, but the market was doing fantastic. Yep. Could we enter a scenario now where the economy is doing well or better than expected, let's say, and U.S. markets perhaps start faltering here? I know Goldman Sachs just came out with a piece that has gotten a lot of press in the last 2 days, saying that they expect U.S. equity returns to average 3% over the next 10 years. That's lower even than what we expect. We're at 5 to 6. I don't know where you guys are for U.S. equities, but any thoughts?
I'd be more on the 5 to 6, but within that, to your point, yes, U.S. markets did very well, thanks to a handful of stocks.
Right.
Your median stock actually didn't do all that awesome. And I think what you're witnessing right now in the US, as you're starting to see a steeper yield curve, as you're starting to see a broadening out of the growth, is actually the leadership within the market is shifting. So right now, if you look at the US market, for, 10 years, you kept making new highs, and it was always led by tech. It was always tech making the new high first and everything following. What's happened in the past 6 weeks or so is it's actually financials that have broken out to the upside, and it's financials that seem to be now leading the market, which to me makes sense given all the macro things we've discussed, the wider budget deficits, the steeper yield curve, the good nominal growth.
Trump would probably be better for smaller caps, right?
Trump would be better for smaller caps, deregulation,
corporate tax cuts,
and he'd be better for financials. He might even crack down on the Max 7 because let's not forget that the Max 7s did deplatform him back in post-January 6. So,
even with Mark Zuckerberg's mea culpa, so you don't think that's going to resonate with Trump?
I don't know. Do you think do you think he went to Jesuit school like us and is a forgive and forget kind of guy, or is he, or does he keep score? I'm not sure.
Right.
Maybe not. Maybe he doesn't do anything. But what I do think is with the deregulation, with the steeper yield curve, what you're now seeing right now is financials outperforming, financials making new highs. And by the way,
so you think that trend will continue?
I think that trend continues, but I also think that when you have a market being led by financials, it's not bearish. Financials that keep on making new highs means that banks will go out and lend money. It means that economic activity will expand. So, markets that are being led by financials are pretty bullish, actually. So, look, I think that out of the past 10 months, I think you've had 9 positive months and 1 negative month. Are the markets overextended? Yes, they are. Is the election the perfect catalyst for profits to be taken into the year end? Probably, but you can get corrections at any time. Are the conditions there to have a proper big bear market? And I mean like something more than -20, -25? I don't think so. And as long as the financials are outperforming, I think you have to think, okay, markets are okay. Now, having said all this, are U.S. equities the best opportunity set around the world like they've been for the past 10 years? This belief, the U.S. is the cleaner's dirty shirt. The only growth you're going to find is the U.S., et cetera. Absolutely not. I think the opportunity set outside of the U.S. today is so much greater than that in the U.S.
Which markets are you looking at there?
To be honest, I'm looking at Latin America. I'm looking at, frankly, Pan-Asia. I'm looking.
When you say Pan-Asia, you mean non-Chinese mainland
shares? Both.
Look,
I think if you look at China, today, what do we have in China? We have massively undervalued stocks that are building positive momentum at a time when you're getting massive policy support. It's like, what else do you need? And now granted, most foreigners will say, oh, China's uninvestable. I don't want to be there. Too much policy risk or whatever else. But, to get very undervalued assets with positive momentum and policy support, you would expect at least a little bit of hair on the legs.
Right.
And you're getting that's China today.
Well, let's now dive deep into China because, like I mentioned before, you're based out of Hong Kong. Yeah. Gavekal, the company you founded, has traditionally been an active player in the region, providing a lot of research. Like I mentioned to you earlier, a lot of the work that we did with Chinese sovereign bonds a couple of years ago when we bought into them was piggybacking off the work that you guys did.
I want to commend you on that because not a lot of institutions had the guts to buy the Chinese government bonds. To be honest, it was a slam dunk trade back then when you put it on. Philosophically, it was a slam dunk trade. You put it on and it was good money. Yeah. Very few put it on though, even though it made sense, even though it ticked all the boxes. Yeah, you needed the courage to do it.
Yeah, if you did. We put it on right after COVID because we saw the treasuries were not doing, and boons, for example, were not doing what they were supposed to be doing. But the Chinese sovereign bonds were. So it worked out great for us. But like I said, we exited that trade. We've exited Chinese equities a bit ago. Talk to us about what asset classes in China still look attractive to you. Because from our perspective, I'll tell you, as an outsider, it feels to us like the Chinese government does not care if you're a shareholder. They will wipe you out if they need to. They care a little bit more if you're a bondholder.
Oh, they care a lot.
Right. So which is part of the reason why we're so comfortable taking the Chinese sovereign bond risk when we did. How do you see things right now? because to further preface the question, we're wondering, why didn't China stimulate 2 years ago?
Okay.
Or even more, right? Why did they wait this long when clearly there's a savings problem in China, right? So let's hear your view from China, because I'm very interested, and you all should be very interested to hear what he has to say here.
So I think, you got to start off with, to your point, why didn't they do this earlier? Are they stupid? Why? And the old Steve Martin quote that before you criticize anyone, you have to walk a mile in their shoes.
Mm-hmm.
Like this, when you criticize them, you're a mile away and you have their shoes. And I would say that's the case with Xi Jinping. Why did it take him so long? And the reality, I think, if you're the Chinese leadership, you've had 2 back-to-back traumatic events. In 2018, the US government says no more semiconductors to China. This was something they didn't expect.
Mm-hmm.
And all of a sudden, it raised the threat that they could be cut off. Today it's semiconductors, tomorrow it could be chemical products, or it could be, car gearboxes, or, who knows. So all of a sudden there was the belief we need to be self-sufficient in industry across the board. Now, if you think the US is now out to get me, which was basically what the US signaled when they said no more semiconductors to China, it was in essence a declaration of economic war,
right,
as far as China saw it.
Yep.
And you think the US is out to get me, and you're China, what's your single biggest vulnerability? Forget semiconductors, forget that you have to import a lot of your energy. Your single biggest weakness is that you settle most of your trade in US dollars,
mm-hmm,
right? And so if tomorrow the US decides we're going to ban China from the dollar system, like we've banned Russia, like we've banned Iran, like we've banned Venezuela, then all of a sudden, China's trade collapses and the economy goes down the drain. So if you're a Chinese leader, you think, okay, I have to de-dollarize my trade as quickly as possible. Now, to de-dollarize your trade, you have to have a credible currency and a credible bond market.
That's really that you can exchange it, which is not the case with the renminbi, right?
Yeah, but you can move it. You can move it around, like every year it gets incrementally better,
mm-hmm,
and that goes back to what Deng Xiaoping said: "We'll feel the stones as we cross the river." Chinese policy is always pretty slow moving, but the view was always we have to make the renminbi a credible currency.
mm-hmm.
So if you think, there's really 3 markets. You got your currency market, your bond market, and your equity market. If you're a Chinese policymaker for the past 6, 7, 8 years, you thought, I have to have a strong currency, I have to have a strong bond market, and the equities can settle where they settle. In the US, of course, it's the reverse. In the US,
right,
it's 70% of people own stocks, so we have to have a strong equity market.
mm-hmm,
And as soon as the equity market maybe might go down, we'll cut interest rates.
right.
And the bonds, we still want to have a decent bond market, and the dollar can settle where it settles. As Treasury Secretary Connolly told the Europeans, US dollar is our currency and your problem. We don't really care.
Right.
So in the US, everything is done for equities, and in China, everything is done for the currencies, for the exchange rate, which brings you to why you couldn't do it 2 years ago.
Mm-hmm.
2 years ago, what was going on? The Fed was tightening,
mm-hmm,
the US dollar was going up, and the yen was collapsing. So if you started easing then, the risk was that your renminbi would start going down very aggressively. And if your renminbi went down very aggressively, you could get massive capital exodus, your bond market would get crushed, and you would become even more dependent on the US dollar than you were before.
mm-hmm.
Why are they doing it now? Well, now you have a window of opportunity where the Fed is cutting rates, the US government is going down, fiscal profligacy, like just spending money willy-nilly.
Mm-hmm.
The US dollar has been in a trading ban for a while. The yen has started to rally, although it's been weak in the past few weeks, but up until recently had started to rally. So if you're China, you're less worried about the renminbi going down now. And so now you can put a floor on the equity market. Now you can stimulate. Now, also what's happened in the past 3 years is that 3 years ago, China's trade surplus was 25, 30 billion a month. Now it's 80 billion a month. As all of a sudden China becomes the biggest car exporter, the biggest industrial robot exporter.
Right.
As all these things happen, so when you have a trade surplus of 80 billion a month, you no longer have to worry too much about the level of your currency. It's going to be underpinned by all the, if you have 80 billion coming in, month out,
right,
that's going to underpin your currency to some extent. And so for all these reasons, you now have a window of opportunity where I think if you didn't care about your currency, like the U.S. doesn't care about their currency, then you would have
Clearly.
stimulated 2 years ago. But if you care about your currency, you couldn't. So that's the answer to the question.
Okay. So where in China would you focus as an investor right now?
So that's a great question. That's a super important question because I think one of the big challenges in China is, to be honest, the excess of capital. So, if you come into China today and you see a company and you say, hey, I've got capital for you. They say, yeah, take a number. I can borrow money from any bank at a very low interest rate today. So how are you going to get high return on equity when you're competing against that? And here, we were talking about earlier about the cars, how China's become the biggest car exporter in the world. So you may look at this and think, oh, I'm going to own BYD. BYD is going to be the biggest car company in the world. Except that you also have to acknowledge that today, and I love BYD, by the way. I think it is going to be the biggest car company in the world. But today in China, you got 130 EV makers. Because the way Chinese capitalism works, is the guy at the top, Xi Jinping, says we need to be number one in EVs. So every mayor, provincial governor, local party secretary calls the local bank, calls the Agricultural Bank of China and says, hey, give a loan to this car company because they need to start producing EVs. And before you know it, you got 130 EV manufacturers in China, all crushing each other's margins. And of course, that's great for the consumer because you end up with the BYD Seagull that costs $9,500 US, and that's an awesome car. In the US, of course, capitalism works differently. In the US, Tesla gets subsidy from the government, and Elon Musk gets to be worth $100 billion, and you get to pay $70,000 for a Tesla. So it's different ways of the way capitalism works. But as a shareholder, what you have when you have 130 guys all well funded by banks, it's basically the Hunger Games.
Right.
And do you want to play in the Hunger Games?
Right. So you don't want to be a shareholder there. Right?
I don't think you want to be a shareholder because, out of the 130, 5 will survive.
Right.
But the process, even BYD will for sure be one of the survivors. You've got guys nipping at your heels, crushing your margins, et cetera. So when you look to deploy capital in China, I think you have to do it in sectors where there's super high barriers to entry. And for me, there's a few of these sectors. The first and the most obvious one is all the internet platforms. And here, it's the scale effect. You and I could have unlimited funds today where it's going to be hard to displace Amazon. It's going to be impossible to displace Google or Microsoft. And the same is true to some extent in China. So personally, I own Tencent. It's impossible to spend any time in China today without giving some money to Tencent. They own the whole fintech vertical. They own the entire music vertical. I think, there's like 3 times as many subscribers on Tencent Music as there are on Spotify. They own, obviously, the video gaming vertical. Yep. So I own Tencent. I think you want to own Alibaba. I think you own Pinduoduo. I think you want to own Baidu. So those big, huge tech platforms, they have natural barriers to entry. Another sector that has, I think, barriers to entry, frankly, is the Macau casinos. Great way to play Chinese consumption. For your US clients, easy. You buy Las Vegas Sands. It trades in the US. Easy to do. But you buy the Macau casinos because there, again, through regulation, there is no competition.
Right.
Either you have a gaming license or you don't. Right. And they're not making any new gaming licenses. And you get those licenses for 7 years. And so it's it's not a monopoly. It's basically 5 guys splitting a cake, and a cake that's going to be growing very, very fast in the coming years. I think another sector you can look into, and that's a controversial one, is the education sector. Now, the education sector was the one that got crushed. That all of a sudden, when they went after the education stocks, everybody said, I'm out, and sold all their China stuff because the stocks went down 90%. But really what they were doing is actually massively regulating it, and in so doing, putting in barriers to entries to really the 2 companies, TAL and EDU, that are the sort of legacy ones. So these guys now have...
now they've chopped off
all the frauds,
competition. So now's the time to...
And they've put up big barriers to entry. So when you look to deploy capital in China, the big question you should ask yourself is, am I investing in an industry where there's barriers to entry or not? And if there's not barriers to entry... Or
am I investing in an industry that I'm aligned with the government?
Yes, that too.
That's key.
So you start off with that. Start with that. And right now, the government just wants everything to go up. They're trying to crank up the market. So right now, you're aligned. Now, that won't last forever, but for now, you're aligned. And then from there, the second question is there barriers to entry or not? And if there's barriers to entry, I think it's safer place to deploy capital.
Excellent. Well, one final question on China before we move across the pond from here to Europe, because I'm definitely also interested in hearing your opinions there, especially you being a French national. Let's talk more philosophical, longer-term question with China. We saw Xi Jinping basically abandon the traditional party turnover in China there a few years ago, become increasingly autocratic, insular, surrounded by sycophants. We've seen those systems in the past make massive mistakes, right? They can look like they're doing well for short periods of time. I'm thinking of the Soviet Union with Sputnik, right? They marshaled resources. They got Sputnik out there. They got a cosmonaut out before the US did. But over the long term, it's very hard for those systems to outcompete consensus, broad-based democratic systems like the US and Europe. Although we can argue how democratic those systems have become as well. But at least philosophically, what are the long-term prospects for China? We've seen them make huge mistakes with demographics, right? The one-child policy was a disaster.
Yep.
What are the longer-term prospects for the country under the current Xi Jinping regime and its model, let's say? What comes next?
So I do think Xi Jinping going for a third term was a mistake. Like, I think if you go back to, basically, if you go back to China's history over the past 60 years, they had Mao, and Mao basically had all the power, and it turned out to be a disaster.
Right.
And on the other side of that, they said, okay, let's put in a bunch of fail-safes. Let's basically manage by committee. And as they did that, things did get better. Management by committee.
And now they went back to the more Mao system,
with Xi Jinping, you've had indeed this concentration of power, to your point, which opens the door for much more for potential mistakes.
And non-self-correcting mistakes, right? That's the problem, right? It's not that they make mistakes, because everyone makes mistakes. Every government makes mistakes, but they don't self-correct.
Exactly. Well, the good thing about having a change of leadership at the top is you could say, well, that was a mistake, so now we're going in a different direction. But if you don't have a change of leadership, you never get these self-correcting modes. And again, I think to your point, really that's the key advantage of democracy. The key advantage of democracy isn't that you pick the best person to run a country. I think US elections have proven that well enough over the years. It's not that you pick the best, smartest people, but it's actually you get rid of the incompetence. That's the key comparative advantage of democracies, is it allows you to fire the incompetence, really. And so that is undeniably a new problem for China, which wasn't there before, because you were changing people every 10 years, and now you're not. So I can see for sure the discomfort that this creates. Now, what's happened in China is you have changed the entire leadership except for the very top guy. Like, if you look, you had the whole entire Politburo changed. And yes, the perception is that you've just replaced with guys who are Xi Jinping sycophants and are going to be yes men, etc. Perhaps not, though. Like, right now, actually the stimulus is kind of not what Xi Jinping would have done, but much more what the premier would have done. The premier was, the premier of Shanghai, who brought Elon Musk in.
So you think there's enough room within the Chinese government for some, let's say, differences of opinion with Xi Jinping, where there can actually be?
I think within the Politburo there probably is, although nobody knows what goes on behind closed doors.
Right.
But right now, the policy shift feels different. So maybe that's one reason to be hopeful.
Okay. Well, Louis, so we have 5 minutes left. So I would be.
So let's do the rest of the world in 5 minutes.
Well, let's focus on Europe, though.
Sure.
You're French yourself. It's probably been a while since you lived there, but I'm sure you've remained an astute or at least keen observer of what's happening on the old continent. How do you see things in Europe, for example? Investors for years have been saying how cheap European equities are, and yet they remain cheap. Europe also has a massive demographic problem, although they've helped it somewhat with some immigration recently, but then there's been problems with multiculturalism right? Exactly. It comes at a cost. And so although we have seen some self-corrections there in Europe too, right? They've realized, hey, this is not a great idea. Maybe we got to integrate people more. So give us your overall panoramic view of Europe.
Look, I think cyclically right now, the sort of Damocles sword problem we're facing is, I think we're heading straight into a budget crisis in France. Budget and political crisis. We have
similar to what happened to the UK.
Very similar. I think France is basically facing its Liz Truss moment, where, most people like to look at government debt as a percentage of GDP and say, oh, if you're above 100%, there's a problem. But that's not really the matrix you should look at. What you should look at, it was true for the UK, it was true for Greece, it was true for Brazil and Argentina. It's the percentage of debt held by foreigners. And when you get to both over 100% debt to GDP and more than a third of your debt held by foreigners, you risk the moment where foreigners decide, you know what, why do I own this?
Or you have to pay me a lot more.
Or you have to pay me a lot more. And this is what happened to Greece. Like, I don't want this anymore. Just get rid of it. And you can't roll over your debt and you end up in a crisis. It's what happened in the UK a few summers ago. And I think this is where France is heading right now. If you look at countries today that are roughly a third of their debt held by foreigners, there's two of them. Amongst the major debt issuers in the world, there's France and there's the US. Now, arguably, you could say the US is first amongst equals because it's the world's reserve currency. Nobody's going to sit around and say, why do I own this US Treasury? Well, you own this US Treasury because you don't have a choice. If you want to buy oil in the future, you save in US Treasuries today.
Right.
But you could easily turn around and say, why do I own French debt? And I think we're coming to
well, that's easier to say. Why do I have to own French debt?
No,
right?
because you don't
have to.
You don't have to. Right. And not only that, even if you need euro exposure, you know what? I can own Italian debt that actually yields more. I can own, Dutch debt, so I think we're heading into a crisis moment for French debt pretty soon.
Okay.
And yes, to your point, I think if you have a debt crisis, it's hard to get super excited about the equity markets locally, right? Because it's like bond yields go up. That is a hell of a headwind for.
Would that spread out to other markets as well beyond France? Do you think, or do you think that's a idiosyncratic problem of France given their debt dynamics?
Well, so I think this is an important question because then the question, okay, France starts hitting the skids. How does the ECB respond? If the ECB steps in to buy all this excess French debt that's being issued, does the euro take another leg down? If the euro takes another leg down, where does that leave other currencies? Are we back in a strong dollar environment? And, as a guy, I've just tried to, say, load up on emerging markets. Whenever you make a scenario, you always think, okay, what could go wrong? And for me, that's what could go wrong. Like I'm a super bull on emerging market debt. I love Latin American debt. I love Latin American equities. I love Asian equities, Asian debt. What could go wrong is the dollar gaps up because of another round of euro crisis. And I don't think the probability of that is zero.
Okay. Okay. So then final question for today. What, in your mind, if you had to only harp on one risk you see as a major risk, whether it's because it's the most probable or it's the highest impact or both, which is the greatest risk out there?
Okay. I think there's two.
Let's hear them.
I just mentioned the French one. As one, I think people are underestimating the risk of.
So you think that could lead to some global contagion, right?
Well, through a higher dollar. To be honest, like France hits the skids, everybody says, I'm going back into the US dollar, and then, for the way I'm positioned today, that's what I worry about. The other thing I do worry about, but doesn't seem to be happening, is oil prices shooting up. Now, I think what you've seen in recent months is inventories all around the world being drawn down, partly because the cost of inventory with interest rates being higher, et cetera, has been higher. So everybody's drawn down their inventories, record short positions out in the futures markets against a geopolitical environment that frankly stinks. And so, could oil rapidly move from $70 to 110? I think there is that risk. And if it does, then nothing works in the portfolio. It's what we saw in 2022, where oil went from 70 to 110. If you had energy, you did okay and you had a decent year. If you didn't have energy, your bonds blew up, your equities blew up, your tech blew up, everything just didn't work.
So you would have it as a hedge, right?
I would own
not as
energy.
A base.
Yeah, I would own energy because I'd have 20% of my portfolio in energy, to be honest.
Because the geopolitical argument for wanting to own it or for not wanting to have it is that if we're in this sort of Cold War II bipolar, that's a quite stable geopolitical framework, right? Where you have ultimately the US and China keeping the other players at bay, saying, okay, we're going to have a little war in Ukraine. And I'm saying this facetiously, of course, but we'll have our little battle in Ukraine. We'll have skirmishes in the Middle East. We'll do, lots of military drills in the Taiwan Straits. But we're not actually going to go to open warfare between the U.S. and China, right?
And then the 80% does great.
Right.
So I think you have, it's, again, the idea of a hedge. For me, the big risk in the world is that oil prices spike. And this is, again, what we saw in 2022, which is why US Treasuries are no longer the proper hedge on a portfolio. You know,
Right.
Your typical portfolio used to be 60% equity, 40% bonds.
I agree with you there.
And
yeah.
if there was a growth slowdown, your bonds did well, your equities did badly, and all in all, you were fine.
Yeah.
What we saw in 2022, I think, is the future type of crisis where we now live in a structurally higher inflationary world. And when there's a problem, bonds and equities actually both sell off together.
Mm-hmm.
So you need a new asset class that when your equities sell off, assuming you don't have bonds, that
gold, commodities,
right, yeah. And gold's obviously run up a lot. The
Would
reality,
you still own it here?
I would, because I think it's a structural shift. Yeah. I think the gold going up is really a reflection of central banks buying. I don't think that stops.
Right.
In fact, it probably accelerates. It's a symptom of the Cold War too, frankly, that you highlighted. So I think you do buy bonds on dips. I mean, you do buy, gold on dips, but energy is what tips you over, frankly, from expansion. I said, look, U.S. economy is not landing, it's doing fine, etc. The one thing that pushes you into a recession is oil at $110. That squeezes consumers. So that's why you need to hedge. And fortunately, I think hedging that doesn't cost a lot. So you can either buy way out of the money call options on oil, but you can buy energy stocks that have pretty decently high yields. If you don't consider them part of your equity portfolio, you consider them as a hedge. Yeah, they haven't done very much in the past 12 months, but they offer high yields. And if ever there's another 2022, these things double while the rest of your portfolio goes down 30%.
Right. Well, that's all the time we've had today. So thank you all for joining us. Louis Gave, co-founder of Gavekal. Thank you so much for joining us.
Thanks for having me.
Thank you.
Thank you.
Insigneo Financial Group, LLC, comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insigneo International Financial Services, LLC, headquartered in Puerto Rico, and through Insigneo Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insigneo Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insigneo International Asesores de Inversión Uruguay, SA, Insigneo Asesores de Inversión Latam, SRL, and Insigneo Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insigneo Argentina, SAU, and in Chile through Insigneo Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insigneo Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insigneo.com/disclosures/ or via www.finra.org. To learn about Insigneo Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.